Well, it looks like it might be a better week for rates than I originally thought. So on Thursday, the 10-year fell almost 5 basis points, and the 30-year fixed, according to Mortgage News Daily, was down 5 basis points. And they now have the 30-year fixed at the lowest level in almost 4 weeks. So what is happening? Well, on Thursday, we got more inflation data. The PPI, Producer Price Index, fell more than expected, and that was better than CPI, which was as expected. PPI, better than expected. Prices were flat month over month, and annual inflation fell more than they were expecting. So why are the markets reacting this way? Well, after the last meeting, everyone was sort of thinking that, okay, the Fed is going to have to raise rates in September, and the bond market started pricing that in. And then last week, we got a bad jobs report. Now there's concern about the labor market, and now PPI, which front runs CPI, is doing better than expected. So now all of a sudden, the bond investors are thinking, well, maybe there won't be a rate hike in September. So now they have to price that in. That's why yields are falling. So it's not that the Fed's going to cut rates in September. It's now they might not hike them in September. So the bond markets are pricing that in. And speaking of the labor market, we did get jobless claims, which were up a little bit. But from a historical perspective, we're still kind of near all-time lows. And so there's a lot of confusion about the labor market, and inflation is improving. And so the Fed has a little bit more runway to not hike rates. And so we are seeing the bond markets respond, and we are seeing rates falling. And so it's a good time for you to take advantage of that.